Good day, folks, and welcome to the Week Ahead Insight for the week beginning December 30th, 2019. Have a really interesting confluence of events to talk about, so let's get going. So, as usual, we'll start with a chart of the ES S&P 500 futures, which for the first time we saw a bit of a different ending to the week. This is a 3-year weekly chart, and we had a bit of selling that came off of a gap up on Friday morning that finished near the lows of the range um, for the S&P 500, which was also mirrored in a lot of the different markets, the Dow, the Nasdaq, and the Russell 2000 as well. However, you can see here in the overnight session, we are currently up just about 5 points, which we probably should be testing the underside of this range here at around 32.47. And so that would definitely be the first place of interest to look at if we can get back to this 32.47 area to make any meaningful test into this regular trading session high, sorry, pre-market trading session high at 32.54. What we do want to see is if we have the strength to make that high in the regular trading hours, which would probably give us a fairly good clue as to the continued direction, at least in the short term, of the S&P 500. Looking at, for example, we have the NQ, the Nasdaq. As you can see, a very similar story happening in the Nasdaq as well, where we opened up on Friday from the pre-market highs, setting new highs here at 88.43, and then fairly immediately we sold off into that open. We had just a short sort of short covering rally intraday, and then pretty much we had consistent selling throughout the day, had a nice dip, and then being bought back up now, testing and climbing a wall of worry, probably back into this 88 20 range. And so that's the first point of interest that we really should be looking at, that 88 20 60 or so. And again, just like on the S&P 500, can we get back to this 88.43 level during the regular trading session tomorrow or later this week? Again, we are in December, which is a seasonally bullish time. And so, given the fact that the Bulls have had the ball and the practically the run of the field for the last several months and definitely the last several weeks, the bias, I believe, has to go to the Bulls at this point. However, as I have continued to advocate to clients, this is definitely, especially in a low volatility environment, this is definitely the time to be purchasing portfolio insurance because it simply makes sense as it is both cheap and continues to remain valuable as a hedge after a near 30% return this year across the indices. It is always prudent to protect your gains. And so let's take a look here at the the Russell 2000, which, to be fair, has been acting differently and has not reclaimed all-time highs at 1742, but has acted as a leading indicator of market strength. Now, clearly we can see, as we discussed in some several videos past, the Russell is breaking out of this year-long consolidation between a low at around 1450 and a high at around 1610. And so having bounced around in this consolidation and now breaking out with some momentum and some confirmed price action and follow through to the upside, now we're seeing just a tad bit of caution coming in here at this level at around 1675, which happens to coincide with this area right around here of consolidation that it went through previously. And so This at this stage is still very healthy action. Let us see in the coming week and or weeks if we can retake this most recent high at around 1681, or do we have some back testing and backfill that will come in to take us to retest the 1621 breakout level that is going to tell us whether we are going to continue resuming this uptrend looking to test 1742, or if we're going back into the range at 1600, and quite possibly much lower from there if we do see a significant decline. So let's take a look at gold. Gold has been on quite the little run, and it is not necessarily the easiest vehicle to trade because of how sometimes it goes near dead. It plays dead for quite some time, I suppose, to lure in both buyers and sellers who are convinced one way or the other about their thesis before it decidedly rips in one direction, hurting one side and making the other side happy. And so for now, you can very clearly see the top of this range here at around 1520. Gold decidedly broke out of this little sideways consolidation pattern that it was um, developing over the past several weeks, for almost 6 weeks now. Many of I guess the talking heads, both on television and on the internet, have been looking for this possible breakdown at around 1460 to see if this was a bear flag in the making that could have possibly taken us back down into these sub 1400 levels. But with this move earlier on this last week that has now decisively broken above this 1490 level, and we're now testing the 1520s, should in my opinion, give the ball to the Bulls camp. And so what we possibly will see in the ensuing weeks is a bit of a sideways consolidation as we come back into this congestion area that gold spent quite a number of weeks in: 9 weeks before it broke out of the range. And so we may see a pause here for some time before we continue to see a resumption of the trend to test the most recent high at 1566. And then if we go back even further, possibly to testing this nice round handle number at 1600 before possibly seeing any further pullback to this 1550 level. So that is gold. Let's take a look at crude oil. Crude oil also has been having a very nice last couple weeks, not seasonally so, but just simply based on the price action. We have some very clearly defined levels that we can watch and be watching for to indicate and give us clues as to what direction crude oil and or the nature of the market participants in crude oil. And so we have this very well established low here at around 52.80, 53 thereabouts. And again, sucked in a lot of shorts given this very bearish candle here, where we went up to test the intermediate highs of the range at around $63, and we were immediately and convincingly rejected to the other side of the range, but we held this very clearly established level at around 51, which set us up for some upside with some positive news headlines that took us into the 61, currently 61.74 level. So what I would definitely be looking for in the short term is now that we've come into this area of consolidation here, let me put that in so you guys can see it a bit clearer. Now that we've come into this former congestion area right around here, as you can see, we've now come back to that area. I would expect a bit of a pause in the ascent. And as you can see as well, this very clear, very well defined, and easily seen upward rising channel. We're now at the very top of that range, and so probably what we can expect, at least for the next week or two, might be some digestion, continued digestion in this range, bouncing around between 60 and 62 before we get a more meaningful move either to the upside to retest the underside and the intermediate highs at around 63.20 before possibly rolling over just a bit to retest these lower consolidation levels at around 59, and possibly if we get back down into the range all the way back to 52 to 54 range. That is crude oil. Let's take a look at the VIX. And as we've spoken about previously, of course, the VIX is the measure of volatility on the S&P 500. And so what is very important to note, as we always say, that price has a nature, and it is always important, more so than what it is doing, is what it is not doing. And so, given the fact that the S&P is essentially at all-time highs, yet for the last couple days or so, what do we have here? We have a very clear uptrend in the VIX. This is not usually, this is not typical, because as the volatility, as the price of the S&P goes up, the volatility of the at the money options in the S&P typically go down. But the fact that we're seeing a rise in the VIX actually conveys to us that there is more demand for, or more or greater expectation of volatility picking up in the future. And so this is something that we ought to pay attention to and be very cognizant of in the midst of the very bullish season, in the midst of all the fervor and the fanfare about the returns that the market has made this year, recovering all of last year's losses and adding on quite a healthy chunk. This is one of those things that we need to be paying attention to in terms of what under the surface may be brewing for the first couple weeks of January and perhaps the first quarter within the wider markets. Let's see the VIX for the Nasdaq, the VXN. Very similar story here as well. Clearly in the midst of a downtrend. Clearly in the midst of a downtrend, but as we have come into all-time highs once more, or near all-time highs once more, we have actually now started to trend upwards. Even in the short term, this is behavior that needs to be taken into consideration. And so, how do you incorporate this into your possibly active trading or intermediate trading framework? Well, you have to be a lot more um, aware of the possibility of longs becoming very stretched. And so now would definitely be the time to begin trimming this your position sizes, would be taking profits a lot faster and not allowing yourself to give back a lot of what has been previously made in an attempt to continue riding what may now be a trend that is showing signs of exhaustion to the upside. Or if you are someone who typically does not like to take profits before a confirmed sell signal, and you are familiar and comfortable with options, then perhaps this is now definitely a time that I'll be looking to sell some out of the money call options against my long positions, so that I take some of the delta risk out of my core portfolio, because then I am now short some out of the money call options to bring in some premium to take a little bit of the sting out of any possible pullback that we do have in the short term, if you do have the opinion or share the opinion that we actually will continue to remain elevated and churn and chop and possibly grind higher in the new year and new quarter. Let's just take a look at UUP, which is the US dollar index. So as you can see, I'll just change this to a weekly chart just so you can see a bit clearly. So the US dollar has been king for just about 2 years now, coming off of this very nice, well-defined bottom. We have had a very, very nice uptrend in place, which has now been decisively broken with this bearish bearish candle taking out weeks of price action here, consolidating at these highs. And so again, this is a change in nature that we ought to be paying attention to. If you are long the US dollar, you're a long securities or investment and asset classes that are bullish the dollar, this is a time to begin looking to book profits and not ride out what may possibly be a trend that is now showing signs of extreme exhaustion and or confirmed reversal. This of course would also apply to currency pairs like the euro. See, having a bit clear downtrend, but now having a bit of a change in personality, possibly breaking to the upside to test this most recent highs at around 115 at 114.85 at the highs of the range. Let's take a quick look at the pound as well. Of course, there's geopolitical risk and some headline risk with the pound, but also with the weakening dollar, you're going to find that the pound now has a bit more strength behind it because of the weakening interest rate policy um, environment in the US. And so pound recently tried to break out of this 133.50 level, was rejected, but now we're climbing a wall of worry back into it to see if we can grind and build some value possibly in this highs of the range between 132 and possibly 133 before we probably make a more sustained attempt into these higher levels, going back into 138 and possibly 144 in the new year and continuing throughout the summer. All right, guys, be safe out there, preserve your gains, and let's look forward to a really productive and fruitful year in the markets. I'll see you next time. Cheers.